Hello, everyone, and welcome to our webinar Lido speaker series today, Post-Pandemic Strategies for High Net Worth Investors. I'm here with two of our associates here at Lido, Bob Marton and Mike Burke, and today I'll be moderating the session and going over this really exciting topic that we have in store for you today. But before we dive into the topic today, I'd like to take a moment to point out a few of our webinar features. So at the bottom of your screen, you will see a Q&A button. And I encourage you to submit your questions as they come up throughout the presentation today. Your questions will be anonymous to the other attendees, so don't be shy, don't worry about that. I'll reserve some time at the end of our presentation today to address the questions that were sent in. We'll also try to address some of the questions as we go along if we get that opportunity. But if after all of that, if your questions occur to you after our presentation has concluded, feel free to reach out to the speakers directly. At the end, we'll be providing our contact information, or you can go find us at lidoadvisors.com. So just a brief intro about myself. I'm a director and wealth advisor at Lido Advisors. I assist our clients with their wealth management needs and objectives. I am based in our Pasadena, California office, and I work with clients here locally as well as in various parts of the country. In a few minutes, I'll let Bob and Mike introduce themselves, but I would like to also share with you a little about Lido for those of you who are being introduced to Lido for the first time today. So Lido Advisors is a national wealth management firm which currently manages $7.69 billion of assets under management. And at Lido, we look to address the full picture of our clients' financial endeavors. So not only do we look at investment strategies, sectors, trends, and opportunities in the financial markets, but we feel it's equally important to customize the investment approach with timely estate and tax planning advice. So in other words, for our clients, financial planning and investment management go hand in hand. So as far as our topic today and what Bob and Mike will be speaking on as we go through this, so it's an understatement to say that the pandemic has impacted all of our lives. While no one has a crystal ball, we believe that someday, and someday maybe soon, we will be in a post-pandemic world with lots of what we've experienced behind us. So in a post-pandemic world, it is our standpoint that there will be both risks and opportunities. And as we look to move forward from the season, as advisors, investors, and planners, we want to be proactive, tactical, nimble, and seek to address both risks and potential opportunities in the world ahead. So as I mentioned, I'm joined here by two of my colleagues, Mike Burke, who is an executive vice president in our advanced wealth planning department, who will be discussing some of the planning tactics and ideas from a financial planning standpoint today. And Bob Marton, a managing director for Lido based in Boca Raton, will be discussing post-pandemic investment strategies that we're talking about today. But before we go any further, I'll just turn it over to Bob and Mike to introduce themselves, and then I'll kind of lay the groundwork from there. So Bob, why don't you start with introduction?
Thanks so much, John, and thank you for everybody that's joining us this afternoon. As John said, my name is Bob Marton, proud to be managing director based out of our Southeast regional offices in Boca Raton, Florida. I got my start in the finance business in the mid-'80s, working on the floor of the New York Commodity Exchange and the oil pits. And so excited to be here today and share with you what Lido Advisors and our team is thinking about markets in a post-pandemic world. And we'll get back in just a couple of minutes to do that. And Mike, if you want to introduce yourself, and then we'll get rolling.
Excellent. Thanks, Bob. And thank you, John. So my name is Michael Burke. I run the advanced wealth planning team here at Lido. And really, my job comes from our family office background. Now, for those that don't know, the term family office is what happens when a single family has 500 million or $1 billion. It doesn't make any sense anymore to go outside to a number of different advisors. Instead, it's much easier to bring everybody in. And that's really what my role is in the advanced wealth planning. I work with a client's advisors, both on the investment side, as well as the tax side, as well as the estate planning side, and even sometimes the insurance side, to make sure that we are coordinated as we build the plan. So all day long, I'm doing financial planning, and I can't wait to talk about it a little bit more in just a few minutes. So thanks so much for having me again.
Great. Thanks, guys. So the kind of the agenda for today here is we're going to take this in two pieces. So Bob is going to be talking about specific investment strategies and concepts that we think are applicable in today's world. And so Bob and I will be going back and forth for a few minutes here. And then Mike's going to come back on to talk about some of the planning strategies and tactics that can kind of go around those investment strategies. So Bob, we'll start with you, and then Mike will chat with you in just a few minutes here. So,
Excellent.
So Bob, obviously there's so much that's happened. There's just with the pandemic and the news and the media and just everything going on in the country. And so it's kind of our opinion, it's time to look ahead. And there's a lot of things coming down the pipe that we as investors need to be concerned about and consider. So, and one of the things that's in the media, we all know that it's happening, it's in process, is there's a lot of talk about infrastructure and Biden's infrastructure planning. So with so much talk in Washington about investing in infrastructure, could you provide us with some insight as to what areas the government might focus on? And does this create any potential investment opportunities?
Sure. Thanks, Sean. Absolutely. So, just a little bit of insight to what that might take shape and look like and what kind of support is around that. So recent polling showing that about 68% of US adults really are supporting the president's infrastructure package. We don't exactly know the final size of it, whether it's going to wind up being at $1 trillion or $2 trillion, but it's likely to be very, very large. And as I said, a lot of support around it. The key areas where it appears to be focusing are around building and repairing American roads, tunnels, and bridges. That seems to be one of the centerpieces around it, which absolutely creates an opportunity set. Right behind that, there's a big need for fixing our water infrastructure and pipes throughout the country, providing more housing for elderly, a big push for internet broadband into rural areas, and for building schools. So at Lido, we really kind of thought about this and said, okay, if we're talking about roads, tunnels, bridges, a potential benefactor of that might be a large industrial company like Alcoa, one of the world's largest producers of aluminum, stock trading in the mid-30s right now. So when we looked at that, we didn't just simply want to go and purchase Alcoa on its own. So we developed a strategy that's up on the screen, and it's called the Alcoa Gap Trade. And it's a trade that lasts for a term of 9.2 months from now. And what we're looking to do is purchase Alcoa for the next 9 months with the potential of making just under 14%. At the end of this term, if Alcoa is up 5 or 10 or 14, we capture that gain. If it's above 14%, we no longer participate. But we're more concerned about what our downside looks like. So when we develop this strategy, we will accept the first 8.8% or almost 9% of downside if Alcoa doesn't perform or if infrastructure is delayed. But beyond that 8%, we can build in 53% downside protection. So when we step back at Lido and we look at this potential opportunity set for a period of 9 months, the opportunity to maybe make just under 14%, will take a risk of being down almost 9, but being covered for another 53% makes it for us a much more attractive way to potentially participate in that infrastructure play, if you will. But in looking at Alcoa and understanding where the market is, we observed another opportunity set in Alcoa. And it was for a similar time frame of about 9 months. And what we observed here, based on where the market's trading and where options are trading, that we could invest in Alcoa for this same 9-month period. But what's quite different here is we have a potential to double the upside return that Alcoa might give us with a limit of making 56%. So if you were to look at the chart on the right, starting at 0, as Alcoa goes up, you'll see our return in the strategy goes up more. So if Alcoa were up 28%, we'd be up 45. If Alcoa is up 37, we're going to be up 56. So it's a way to get a leveraged return from Alcoa. But what's really interesting here too is that we can still have protection. We still take about an 8.5% assumption of risk for ourselves. But after that, we can still get another 14% of downside protection. So, at Lido, we're very focused, very obsessed on looking for opportunity set. And this is an example in infrastructure of how we would go about it.
So it's a way to try to take advantage of a potential opportunity with some protection in the near term, especially with all the uncertainty right now, and as in terms of how things are going to roll out. It's a way to kind of have a foot in that investment with some downside protection.
Well said, John.
Great. So yeah, that's just one example, obviously, of how we're looking at the infrastructure plan and ways to take advantage of it. But I think kind of the concept is there, like I said, just protection, uncertainty, and trying to take advantage of those opportunities. So infrastructure is in the news, and in this post-pandemic world, another thing that's really been getting a lot of attention is interest rates. So the potential of rising rates, what's that going to do to the financial markets in general? There's just lots of questions about interest rates, and we don't have a crystal ball. We don't know where things are going to go necessarily, but we want to be able to take advantage of trends. So with the focus on rising interest rates, Bob, it'd be great if you could comment on this and share how could somebody actually invest in a trend where they think interest rates are going to go higher?
Great question. So, in March, we saw the 10-year Treasury climb to pre-pandemic levels and hit 1.77%. And it's important to note that, coming into the year, we were sub 1%. Before it's kind of settled about 160 right now. So, a move from below 1% to 1.77% is significantly important. And, it's important to understand how that translates into stock valuations as companies depend and rely on easy borrowing at low rates to fund future growth and future earnings. So as we look at that trend, John, to potentially higher interest rates, we looked at it and we said, okay, there's a liquid ETF called TMV. And the way that TMV operates, it's an inverse relationship to the 20-year Treasury bond index. So what the value of TMV does is as interest rates go higher, the value of an investment in TMV will go higher as well. And what we did is we created a strategy where we could go for a short term, and you'll see on that screen here, about 7 months, where we can invest in TMV and again, look for a leveraged return. This strategy is a little different than the others I just spoke about. There's no protection. We're going to lose dollar for dollar on the downside if the market is negative. But on the upside, what's going to happen here, and if we kind of look at this chart on the right, we're going to get this levered return. So if TMV is up, 3.8%, we'll be up 8%. All the way to about 30%. If TMV is up that much, we'll be up 61%. Again, 61% being our max. We can't be up any higher than that over the 7-month period. So a very, very succinct strategy. If interest rates are going up, we are going to get a levered return on that move.
Right. So again, it's a way to, with all the talk on interest rates and rising rates, as opposed to being afraid of it, looking at ways to take advantage of it potentially and benefit from a rise in rates with, again, some protection in place to take advantage of that.
Correct.
All right. So infrastructure, rising rates. Another thing that's in the news kind of connected to rates is yields. So there's just, getting any yield on a savings or anything like that, it's pretty much close to zero. And so let alone when you go outside of a saving, in the good old days, you could put money in the bank and in your savings, and your allowance money would actually earn interest. I don't know if kids know what that's like anymore, but when you move away from money markets and you start to look at savings accounts and you look at bonds, municipal bonds, even high quality corporate bonds, the yields are so low. So there's a place where yields may be higher, and which are known as high yield bonds, or otherwise known as junk bonds. Bob, could you comment on some ways that investors might participate with high yield bonds as a way to
Absolutely,
make some
John.
money? Yeah.
It's interesting, as you and I were talking right before this seminar started, that some 20 odd years ago, planning for my children's education, money markets accounts were paying north of 8%, and we're in such a different environment in the current world. So the question really is, are high yield bonds worth the risk? We're in such a low interest rate environment where we're looking at higher yield investments paying 3 to 3.5%, and we're grappling with, is it worth the amount of risk to take that on? And we have seen US, Europe, Asia Pacific have a big increase in high yield issuance in the first quarter of this year. So there is definitely demand for it. So as we look at that, we're also looking at equity markets and looking at high dividend yielding stocks and a number of different ways to potentially generate some income. So as we looked at that, John, a lot of the strategies that we use incorporate the purchasing of options. And when we do that, we're buying a premium. We're paying a premium to have that investment. So when we were looking at this current environment, we said, hey, what if we look at where the market is and we take that opportunity to actually sell premium? So what we're looking at over here is a chart of the S&P 500, a high income trade, using junk bonds as the collateral. And when you evaluate an investment, one of the many metrics is traditionally there's 3 potential outcomes. Markets go higher, markets go sideways, markets go lower. You make money in one of those 3 environments. But in this instance, if we're selling premium into the market, what happens is we turn those odds a little bit more into our favor. Meaning, if markets go higher, we're going to make money. If the market goes sideways, we're going to make money. So this is a longer dated trade in order for it to function. So it's about 32 months. And we sell this premium, which brings us in this 18.6% return. So if you look all the way over on the bottom right, you'll see we have the return of the S&P 500 represented by SPY. That is the liquid ETF that tracks the S&P 500. And you'll see that if the market's just up slightly or anything better at maturity, we're going to make a return of about 18.6%. But what's really fascinating to look at is that if the market is slightly lower, we still might even have a return. We don't start to give anything back until the market's down potentially about 20%. So if you're bringing in, an 18% premium over a little less than 3 years, you're talking about kind of annualizing that at a potential of about 6% on an annualized basis. So again, looking at markets, understanding with depth that there's premiums in the option market. Here's an opportunity to actually sell some of that premium and have a very favorable return over that period of time.
Got it. Thanks. So, we're kind of looking at several different angles here. A way to invest in the equity markets through kind of an infrastructure play, participating, benefiting from rising rates. Also, a way to play the kind of the high yield market. So let's kind of move away from the kind of stocks and bonds in general here just for a moment and just talk more about yield and specifically income. As we're kind of emerge from this into this post-pandemic world for investors, folks looking to generate higher income, what are some ways that investors might look to do that in today's world?
Yeah, sure. So, John, every day we have inquiries from investors that are so challenged in this low interest rate environment. people that retired a decade ago where the 5% muni was as common as anything. And yeah, they miss those days for sure. So one of the places that we spend a lot of time understanding is in first trust deeds. So kind of a little background there is that post the 2008 financial market collapse, bank lending, starting kind of in 2009, has become much more stringent and much more difficult for borrowers to quickly access funds. So it created an opportunity to provide short-term bridge financing secured by real estate through private investment funds. So typically what these loan pools look to do is invest in real estate where they have a 50 to 65% loan to value for short periods of time, typically 12 to 18 months. And that's a period of time where the purchaser is going to be getting their permanent financing. And so we access multiple different bridge loan funds for clients with exposure to hundreds and hundreds of different individual loans to diversify out the risk associated with it. And we're seeing net returns of 6 to 9% for these investments. So something that's been very boring but stable over many years. And we look back to the last market debacle of 2008, and we saw these function just perfectly well. We look back to COVID in that period of time, again, structured in such a manner and performing very well. So it's an opportunity set to move some of those dollars where we're looking to get a regular income stream to a higher place.
Great. So a way to potentially increase income in a way that's not correlated directly to or connected to stock market returns or what the Fed's doing or anything like that. So something kind of outside of that realm a little bit.
That's exactly right, John. And if we do see interest rates move up over the next number of quarters, there's a lag time, but generally we get to see that reflected in the returns or the yields we'll be able to invest in future first trust deeds as well. So that's positive on a higher interest rate side.
Right. So one more question for you, Bob, and then we'll bring Mike into the picture to talk more about some of the planning topics. So I'd like to go back to the equity markets just one more time. So we're not here to make predictions about the future or what the markets are going to do or not do. But one thing I would comment on is that we are at all-time highs in the markets, the U.S. equity markets particular. And for investors who are looking who want to be invested, but are looking for ways to invest with some sort of protection or hedging, as we say, how might you suggest looking at that from a kind of structural standpoint with structuring a trade to accomplish that?
Great question. Yeah, John, every day on the news, we hear about the S&P, about to or actually closing at a new high. And that creates a challenge for investors saying, hey, listen, I would love to participate. I'm a little hesitant to do it at these levels. Hey, show me a strategy, show me a way where I can feel comfortable investing in this market, but knowing that I have some protection. And so we manage a strategy called cap and cushion. And it's reflected here on the screen, and a little peek behind the curtain, really kind of explaining the details of how this works. So from a high level, what we'll look to do is invest in the S&P 500 for a period of time. By way of example, we'll generally look maybe a little over a year. So gains are treated as long-term capital gains. And when we do that, we will look at where the market is and be able to provide a scenario where we have the opportunity to have a gain on the upside, but also have insurance protection on the downside. So by way of example, we can invest in the S&P and we could look up in a year and say, hey, the S&P is up anywhere between 0 and 8%. That's our client's return. After 8%, the investor's capped. We don't make any of that additional money. It's just the way that the options are priced. But in return for accepting an 8% cap, they have a 16% downside protection. So if we look up in a year and the market's down 5, 10, 15%, an investor has lost nothing. Let's say the market's down 20, they would have been protected for the first 16, their net result would be down only 4. So John, I'll do this fairly quickly, but what we do is we go and we buy a US Treasury bond, which serves as the collateral for the trade. We then buy the market represented by the ETF that tracks it, in this case, SPY. We then sell a put below the market, which gives us downside protection. And you can see the market from when we did this example could fall from 260 to 215, or in this case, about 17%. We're fully protected. And then we sell a call at 280, about $20 above the market, and we have an opportunity to make just under 8%. But what's really fascinating, if you look at the structure, it's known as cashless. So the money we take in from the interest on the bond, the money we take in for selling the call options goes to financing our purchase of the market. So very, very effective. I'll just share with you that we can actually extend that effectiveness in several different manners. The first is the example I just gave is if an investor was coming to us with cash to deploy, but perhaps they already have a portfolio and they're still feeling this way and they want to protect that portfolio. What we would do is a correlation analysis of that portfolio to understand how closely related it is to any market or any index. And then we can actually overlay this strategy on top of a client's portfolio to get that same structure and that same insurance. And then the other place where we apply this is concentrated positions. So, somebody that might have worked for a public company for a long time, or unintentionally, we've seen some investors over the years who were early investors in a Google or a Netflix or a Zoom or whatever it might be, and has seen those values soar to this disproportionate amount of their account or investment account. We can actually go look at an individual security and structure the same type of protections around it. So a very, very effective tool.
Yeah, we do have some questions actually rolling in, Bob. And one of the questions is, does it have to be the S&P 500? Or, I know that you've talked about some of these concentrated positions, but other indices, sectors, kind of how does that work?
Yeah, so John, we can structure this over any index. Most popular being the S&P 500, followed right behind the NASDAQ. We could also do it in international. So any index where we have a publicly traded component to it, we can structure it. Absolutely. Great question.
So in other words, there's ways we can be creative with this, both on the indices, the sectors we're looking, and even sometimes the collateral we use for structuring.
Absolutely. Yes. So John, we can actually take it, and I was using an example of sharing where we could get about 1/3 upside potential and 2/3 downside potential. We can actually adjust that to get about an equal amount on each side. And John, I know we have limited time today, but there is some other interesting things we can do with it, where if we're looking for a very, very small return from the upside, we can actually get exponential downside protection. So we've seen some clients that maybe were sitting on a large amount of cash, having a benchmark of 0, if you will, saying, hey, willing to take a little bit of risk. I wouldn't mind getting a 3.5% return using the equity market to do that. So if we reset and we're only looking maybe for the next year to get a 3.5% return compared to the benchmark of 0 of what is currently happening, we can sometimes see protections 40, 45. We've seen as great as 50%. So a lot we can do there. Great.
Thanks. So, well, thanks, Bob. And I'm going to bring Mike on here just to talk about some planning tactics. But when you come back on, we do want to dive into some of the questions that are coming in here if time allows. So we definitely want to make sure Mike has plenty of time to kind of share his perspective
Great.
And, part of what we've been talking about here with the investment strategies are strategies to grow and protect your money. And Mike's job and his role at Lido is the planning side. So ways to kind of keep your money, from tax strategies and different various estate planning ideas. So that's what Mike is here to share with us about. So Mike, got some questions for you. So let me just cue that up here. So Mike, it's very common for investors and savers, as they're building wealth over their lifetime, that they not only have a diversified portfolio, stocks and bonds and real estate and various other types of alternatives, but they also have many different types of accounts. It's just kind of the nature of the beast. You've got your IRAs, maybe you had Roth IRAs when you're able to fund those early on. You've got your 401k, you've got your trust accounts, all these different types of accounts. So one of the questions that seems to come up often is, which account do you pull from first? How do you structure that? So could you speak to that for a moment?
Sure, absolutely, John. I think that's an absolutely great question. And probably the biggest one that really doesn't get addressed all that often. I'll share a quick story. I have a CPA friend, and we've always had a friendly disagreement over what is more powerful for a client's retirement. Is it more powerful to spend down cash first, thus keeping tax deferral on those qualified accounts, or understanding that we're in very, very low historical tax rates, as well as when somebody goes into retirement, they're also not going to have any income, so they're going to be in very, very low marginal brackets. Does it make more sense to pull from those retirement accounts and let's lock in those very, very low tax rates, essentially pass it through that tax filter on a very tax-friendly basis? This is something that we've gone back and forth for frankly years, and it was always more just guessing until I started modeling this every day. Now, this is something that I look at for clients at least 10 times a week, and the answer turns out to be, it depends. So it depends on what the client's living expenses are. It depends what state the client happens to be in. If they're in California, it's going to function totally differently than Florida. It depends, are they going to stay there, or should we anticipate halfway through a move, maybe to a different state and a different climate? It depends what proportions of their portfolio are qualified money versus Roth versus cash versus brokerage. And it depends how the different investments inside of those buckets are. So really, there's no general way to overall say specifically this is the absolute right way for everybody to do it. But what I can tell you is that we can get the sourcing right. And when that happens, and again, I see this at least on a daily basis, the difference at the end of the plan is over $100,000, maybe $1 million. So it is extremely important and something that we really want to get our hands around.
Right. So in other words, with higher net worth investors, there's no really rule of thumb kind of standard. It's very specific and could change from year to year, just depending on tax code and things that are changing with estate planning laws and those types of things. So
absolutely. As a financial planner, my ultimate nightmare is that the plan gets printed out and left on the bedside table before it gets thrown away 18 months later. We want to absolutely make sure that we're using this to dynamically help improve our clients' lives and the state overall.
Right. Good. So, well, speaking of changes in tax law, so there's been a lot that's been going on during the pandemic, lots of different tweaks of rules, and there was a pause on required minimum distributions, a lot of things that have just been, there's a lot that's been circulating in regulation and the law, tax law and things like that. But there's something that I think as we look ahead in this post-pandemic world, we don't want to forget about, that kind of happened just prior to the pandemic, and that was the Secure Act. So it's still there. This is not one of the things that was changed through the pandemic, but it came, it was in December of 2019. So can you walk us through the impact of the Secure Act and how investors may want to be thinking about this going forward as we start to kind of set our sights ahead?
Absolutely. And I remember that day well, December 20th, 2019. I would joke that it ruined my New Year's Eve, but if my wife heard me say that, she'd tell you she's never seen me happier with how busy we were. So for those that don't know the Secure Act, it contained a number of provisions, but the major two were it moved required minimum distributions for retirees from the age of 70 and a half to 72. So that was certainly a good thing. It allowed a little bit more accrual and some tax deferral. But in return, what happened is there was a provision that non-spouse beneficiaries, and by that I mean moving to the next generation, so that would be children, nieces, nephews, where previously they had the ability to take a stretch IRA, which allowed them to only have to take out 2, maybe 3% per year for their entire lifetime. Now they have to take everything out of the accounts within 10 years. So that was an absolutely huge change. And if you think about what that does to a beneficiary, oftentimes beneficiaries of IRAs that are non-spouses, they inherit it between 50, 55, 60, 65 years old. Those are peak earning years. So if we take the case of $1 million IRA that becomes inherited, getting it out within 10 years, even if you just assumed no growth, even if you just sliced it into a tenth a year, that's still going to be $100,000 every year that has to be taken out, that gets realized as income, and that is going to drive a significantly higher tax bill. Now, there are provisions where it does not have to be a tenth every single year. There's the ability to put it off, sort of kick the can down the road. But there's some issues with that as well. Now, if somebody's going into retirement, certainly it may make sense. Income would no longer be coming in. You're going to be in lower tax brackets. It's certainly something to look at. But at that point, you're really forecasting and making guesses on what the income's going to be later on, and gambling that tax brackets are going to be where they are right now. Because if they're higher and you're having to take out significant amounts in a single year, it could be catastrophic from a tax standpoint.
Also, demographically, I mean, there's a decent chance that when somebody passes away, the person who inherits it happens to be in their highest income earning years. So it's just
absolutely, yeah, without question.
Really, it could be a difficult situation. So, got some questions coming in here, Mike. I want to address and just kind of throw them out to you. So, as we, there again, speaking of conventional wisdom, one of those is that waiting until age 70 to start withdrawing from Social Security, because you get that bump up and higher payments at age 70. So, one of the questions we're getting is, is it a good idea to wait till age 70, especially with all the uncertainty and kind of as we head forward and as a strategy to generate higher income?
Yeah, absolutely. And I can talk specifically to this. Again, as you can imagine, this is something that we look at all the time. In terms of anyone's retirement, in order to recreate the payments that are coming from Social Security, the literature says you would have to go out and buy an annuity in around the $1.5 million range. So even for our highest earning clients, this is a very large part of their retirement, and something that they want to know because they've paid into the system the entire time. Now, to your point, the conventional wisdom, and as you can imagine, I read a lot of financial planning articles. Every single one I've ever seen without fail, the conventional wisdom is always, if you have the ability to, wait until the age of 70. And why is that? If the article goes into depth, what it's going to say is for every year past your full retirement age on the way to 70 that you wait, your payment for the rest of your life will go up 8%. And that is true. It's simple, it's not compound, but it is 8%. And actuarially, when you run the math, when you break down the actuarial tables, what happens is by delaying it from full retirement age, which is usually roughly 66 to 67, somewhere in between there, it does depend on date of birth, to 70, the break-even point where you're going to get more money from Social Security, and that's definitely something a lot of our clients care about, is somewhere between 83 and 84. Meaning, as long as you live to the age of 84, you're going to get more money from Social Security by having delayed. Now that's one way to look at it, and that's really where most of the conventional wisdom stops. Our clients who happen to be high net worth tend to have a deeper level of planning that we really need to look towards. So to do that, what I'm going to do, I just want to share my screen very quickly. Excellent. So hopefully everybody can see this. This is a cash flow illustration for a sample client. Now, this is, of course, all fake data, but that said, this client shares a lot of characteristics with many of the clients that we deal with on a daily basis. Now, if we are looking at the cash flow, we can see the Social Security beginning to come in right at about 67. We see some pension income that would also be realized. And when combined with these planned distributions, and frankly, I wish it said forced distributions, because these are the required minimum distributions that you do not get a chance to say yes or no to. This is just a percentage of the IRA value at that point coming in at the first spouse's age of 72. Once that happens, what we see here is very quickly in this net cash flow column, many of our clients, and this is something that we encounter all the time, many of our clients are in a position where they're being forced to take income once they turn 72 that they don't particularly need. This is basically additional income that comes in, and all it's really doing is driving up their tax bill. They would certainly rather it just grow tax deferred back in those IRA accounts. Now, if we think about what delaying Social Security until the age of 70 does, it means you would not get income in these earlier income years where, frankly, you can use it because you are going into your portfolio. Not that it's problematic for this particular sample client, but that is the time when they can use it. And yes, you're getting a higher payout, but on the other hand, that higher payout is coming when you already have more in than you need, and thus just driving higher taxes. So while actuarially the breakpoint tends to be about 83 to 84, believe it or not, often we see even taking it out to 90 or 95, it's never crossed from a portfolio value, and it's much better to take it in the earlier years, even if it does lock you into that lower lifetime payment.
So it's one thing to look at Social Security in isolation and as to what's going to potentially last longer just by itself, but really, especially for higher net worth investors with significant assets, looking at the bigger picture and how it impacts everything, because that's the bottom line. Is the bottom line. How does it impact the whole portfolio?
Absolutely. You know, we can always solve for getting more money from the government, but ultimately what our clients generally tend to want is to make sure that portfolio is there and passes to the next generation as big and as effectively as possible.
Great. So speaking of the next generation, just a couple more questions here for you, and then we'll bring Bob back on, and hopefully we can address some of the questions that are coming in as well with the time that we have. But it's one thing to do financial planning and retirement planning and trying to see if your money will last you through retirement. So as the topic of our seminar today, this is for high net worth investors in a post-pandemic world. Higher net worth investors are not looking to make it through retirement. Hopefully they've done that for generations to come. And so really what we're talking about is legacy planning and estate planning. So given current tax law and the changes that have been happening and the discussed changes, it's hard to know what will actually pan out with some of the discussed changes, but what do you see as some of the biggest issues in clients as they face estate planning?
Yeah, absolutely. And again, this is something that we see very often. The biggest challenge for really good estate planning is just getting started. And I don't mean momentum, although specifically there is some of that. But really with good estate planning, what you're talking about is moving assets from outside of the estate as early as possible so that they can get the benefit of the time value of money and the growth being outside the estate, taking advantage of some of today's estate tax and gifting tax exemptions. But the question becomes, how do we know? How do we know what still gives us that sufficiency? How do we know we're not going to run into longevity risk? And that's why putting together the plan ultimately is so helpful. Answering questions like, what state do we feel like we're going to retire in? When should we be taking money from qualified accounts that we know if we just leave compounding may hit us with RMDs that are far higher than we need? Should we do Roth conversions? When to take social? All of these questions filter into a plan, and it's only once we've gotten to that point and continually checking it that we can be comfortable understanding that there is significant surplus, and many of our high net worth clients are in that predicament. And with that, that's where the rest of my team comes in. So I run the Advanced Wealth Planning team. We have an entire tax division. We also have an estate planning attorney on staff. At that point, once we've identified it, we can start to look with the expertise of what exactly are the best strategies, again, extraordinarily bespoke for their specific situation.
Yes, I think that's the key for their specific situation. And, I like to say financial planning, it's not a plan, it's a process. And it's something that takes continuous time, care, and attention. And it's a little bit like trying to hit a moving target. Things are always changing, assumptions are always changing, tax law is always changing. So thanks for sharing some of these financial planning strategies and tactics we may want to consider as we look ahead in this post-pandemic environment. So maybe, Mike, you can hang on, and Bob, if you wouldn't mind joining us back. And maybe, Bob, since if you wouldn't mind, Bob has been controlling some of the screen here, putting up our contact information while we try to answer a few questions here. So there's lots of questions rolling in. I hope I can get to what we can here with the time we have allotted. If not, we'll be happy to reach out and discuss specifics. But actually, Mike, I'll just kind of go back a little bit. So could you just one more time kind of review the Secure Act and how spouses are impacted or not impacted by the Secure Act regarding inherited IRAs? That's one of the questions.
And absolutely. And the great news, at least for now, and frankly, I don't see anything on the horizon that I would expect it to change, but nothing has changed for spouses in terms, they would still be able to stretch it over their lifetime. There is still the unlimited marital exemption as assets pass over to spouses. One planning technique that we used to use quite often would be for the spouse to disinherit and either a younger child or sometimes even a grandchild to inherit that part of the money, thus being able to really stretch it out. That no longer makes any sense, unfortunately, because anybody outside of a spouse only gets 10 years. So I would say that's the only planning change, is that we will no longer use that. Let's make sure that all of at least the IRA assets do go to the spouse, but otherwise there aren't any changes.
Great, thanks. Bob, we've had a few questions roll in just kind of about kind of sectors, and as Lido, as we look ahead, kind of are there any things that we're looking at in terms of green energy or Internet of Things or those types of topics? Could you maybe share just a little bit in terms of kind of Lido's perspective, or at least maybe strategies of how we might want to take advantage of upcoming trends in the equity markets?
Yes, absolutely. We have a portfolio, actually, John, that we manage where we are looking forward. We are looking to see where we believe trends might be occurring. So, you touched on EV, electric vehicles is very much a component in there. But when we might look at healthcare, we're looking deeper. We're looking at genomics. So what we'll do is we'll take this sleeve and we will look out into the future based on what we're seeing, where there really could be significant growth. And we're putting all of that into kind of one best ideas portfolio to capture those returns. Great.
And just generally speaking, I know like this is probably a whole nother seminar or topic, but there's a lot of discussion about tax law changes and those types. How do you factor that into planning, especially when a lot of it's still kind of undetermined at this point? So, how is kind of as you map out kind of a cash flow plan or retirement spending plan, how might you factor in tax law change, pending tax law change?
Yeah, absolutely. That's a great question. I can give specifically my opinion. I'll say this is my opinion only, but I do not see them going down at any time soon. In terms of the planning, what we do is we plan with what's currently on the books. So we know for personal tax rates, they are right now, they are on the books until 2025 and 2026. There's going to be a reversion to the tax brackets that were frankly significantly higher that we were in back in 2017. Now, it didn't feel like those tax rates were much higher back then because at that point there were a lot of exemptions. There is at the moment no talk of those exemptions coming back. It's just specifically, but for an act of Congress, we're going to go back to those old tax brackets. So that is currently what we're planning with. But I think you hit on it as we talk about the value of continually working on the financial plan. We don't know what's going to happen in the future. January 1st of last year, I could have never predicted what last year would have looked like in a million years. So things will happen. Things will always come out of the blue, hopefully not quite as big as last year. But that said, the goal is to make absolutely sure we have that core plan built so that we can take advantage of it and be very nimble on our toes once these things do happen, not only from the tax side, but also certainly life events or even the ability for some fantastic deals on, let's say, real estate or other things come up.
Great. Just a couple more questions here, and then we want to talk a little bit about our upcoming webinar. So as you guys might imagine, and I'll just kind of mention this for folks who are listening, that you're tuning in, there's a lot of technical questions on the options trades. I think those will probably be best suited for one-on-one conversations because, as Bob mentioned, we do specifically look to tailor those to each client's individual situation. So we can discuss that kind of with our contact information. Feel free to reach out. That was on the slide that was previously up. One more question on kind of the estate planning front, and then we can talk about this. But Mike, I'll kick this one back over to you. So what is kind of Lido's thinking in terms of kind of how to factor in a potential step up in basis on different assets, and are different assets treated differently upon death for a step up in basis? And I know that's a little bit getting into the weeds, but it's coming up. It's come up a few times. So I thought I would throw that out there. So.
Certainly, and that's one of the it's one of the big items in the news. If you are sort of a wonk like me and read all of the proposals coming out, that's one of those that I started seeing and figured I would stop seeing quite quickly, and yet it's still there. I frankly still think it is a long shot. That is my personal opinion. But that said, it is going to make an extremely large difference in the way that we would harvest gains, in the way we look to take income in the future. So it's really something, if it does come, it's something that we're able to model out just in case right now. But if it does come, it's something we want to be able to react very nimbly for. Hopefully, we at least get it projected into the next year so it doesn't take place immediately or retroactively. I think that would be the case. All the articles that I've read are ballparking. If something does happen, we would have at least a little bit of time to react. But that said, the goal is to make sure we have plans just in case it does, because as you mentioned, it is going to be a monstrous change.
Yeah. So, and just under kind of the current situation, certain assets will take a step up in basis upon death, like certain taxable assets, but retirement accounts don't anyway. So we need to be planning for that.
Exactly.
Right. So, okay. Well, just want to take a second here and talk about our, so this is our Lido speaker series, something we are going to continue to roll out here and hold here on a monthly basis. Next month, we're going to be talking about concentrated stocks. So for investors who have built up have had the good fortune to build up a lot of wealth in one single position or a few positions, and the issue being that there's a big gap between the value and the cost basis. In other words, there's a lot of unrealized gains. So strategies to address concentrated stock, how to, as the tagline here, it got you here, will it get you there? So ways to navigate that and factor that into your overall wealth plan and strategies and legacy planning. So that'll be next month. So I'll be on the lookout for the emails and the invitations. So again, I want to thank everybody for joining us here for this webinar. Reach out by email, by telephone if you have any questions. You know where to find us. And thank you for being a part of this speaker series today.